Moving countries can be one of the most exciting and most challenging things you'll ever do. And we're here to take one big worry off your plate: your taxes. At Expat Taxes, we understand the complexities of Irish tax from your perspective as an expat and tailor our advice to your needs. With decades of expertise, our team at Expat Taxes will help you navigate tax residency, cross-border taxation, reliefs and returns, and will work with your country's tax advisor to make sure your taxes are sorted. Whether you're an individual or a corporation coming from Australia, the United States, the UK, or anywhere in the world, we want to help you. So visit us at expattaxes.ie to book a consultation today, and let's make moving to Ireland easier together.
Welcome to Tax Bites for Expats, the top tax tips you want to know as an expat. The podcast is here to help answer the common queries and concerns expats have when moving to or from Ireland. Complex taxes explained simply. We'll focus on the Irish and international tax issues to be aware of to ensure you save time, money, and stress.
Hi everyone. This episode is part 2 of Stephanie Whitcomb's chat with Maura Ginty of Gintax in Ireland, offering specialised tax services for startups and founders, businesses, and advice for larger projects. In this episode, they point out key tax reliefs for startup founders, advice for investors structuring businesses for investments, and some quibbles with the Irish tax system that would be great for you to watch out for. If you've ever thought about working for yourself or investing as an expat, this episode is a great one. And make sure you jump back to part 1 to hear more about tax specialisation in the industry, advice for startups and founders, and how Maura got her start in tax. Enjoy!
Okay, so I suppose that's one takeaway among the many that we have there. What are the other tax aspects that you would be kind of encouraging any founders or people who are, aspirational founders to think of in terms of their journey through the Irish tax system?
Oh, okay. So this is the one. These are kind of the niche tax aspects that founders, startups should be aware of, but not necessarily mightn't be through the normal. You're setting up a mom and pop store, right? This is not on the agenda with your high street accountant. The R&D credit, right? And that's really important nowadays for startups who are doing R&D innovation. They've modified it in the last few years. It was dependent on corporate tax and payroll tax paid, right? But now it's basically essentially like a grant. It is not calculated by reference at all to your tax that are paid. It's essentially 30% of your qualifying R&D back, right? And the thing to note for founders is that there are tight deadlines on claiming that R&D credit, and you need to be nearly on top of it from the start. And I'd always say to get another, and I don't myself, my firm, it's one of the areas that I don't advise on, because there's two aspects to it. One is the accounting and the tax aspect, which very happy to look at and consider, but the other is the science test. And I just think it really needs a specialist, and that's someone who has expertise, or who knows, and not even expert, because nearly all of the projects are so unique to that client, but knows where to get the specialist expertise in whatever project you're doing. And there are firms out there who are able to drag in the experience. And it's key. The reason I say it's key from the start, and that you need to have documented processes and have good protocols around the R&D credit. It's one of the few areas that I think nearly that revenue it's on their agenda, and that generally revenue do review, because it is such a generous relief. So just to note the R&D credit, because that generally is the one that it is so relevant for founders. And there are two other things that come up time and time again. One, I'm not going to drag down the podcast too much on this one, is the EIS tax relief, which some founders may be aware of, and sure tax relief. So this is where, for someone investing in a company, an investor, individuals, right, not corporates and not VCs, individual investors, generally angel investors into a company, or sometimes yourself into your own company, can claim a tax refund, an Irish tax refund on their investment. It is quite a finicky relief. And it's an Irish tax relief that's governed by state aid, by EU state aid. So it can be on the more convoluted side. But that's not to say that and also there's significant risk for you as a company in getting this funding. The reason I say this, right, is because where one of the conditions aren't met, then the clawback of the tax relief, the investors have gone off and got their tax refund, they're happy out, but you as a company are exposed to that tax clawback. The revenue will assess you as a company on it. So it can be from as a tax advisor, right, for all forms of funding that you could potentially raise, the EIIS is definitely the tax riskiest and the most exposure for a company. But that's not to say sometimes there are very vanilla, straightforward startups that fit right within the conditions, right? And it potentially could be right for you as a company. So I wouldn't discount it, but that's certainly an area that needs a really specialist tax advisor.
Yeah.
But can work very well. The relief at the moment is up to 50%. The investors can get up to 50% of their investment back as a tax refund. So it does kind of marry
Very
the risk
generous.
for the investors. Actually, and a lot of the listeners here would maybe on the other side as well as investors or indeed individuals paying a lot of POIE income. It's the one form of tax relief actually from the individuals that goes against all income, including landlord rental income, share option income. So it's quite a generous relief. But the companies that you're investing in are these very high risk, early stage, most of them early stage startups. So there is, for you as an investor, it's really the commercial risk, not so much the tax risk. For the company, it's the tax risk and just ensuring that it's the conditions are met and are right.
And I know it's come up before as well for us that particularly for perhaps US citizens or anybody with a US tax filing obligation who comes to Ireland, a little bit of caution needed. And obviously, I'm not a US advisor, that some of these investments can not be ideal from a US perspective. It just goes to highlight, and we have the same concept in the UK. They have VCTs, don't they? And, they don't necessarily get the tax relief in Ireland that the investor would have expected. It's this, for the listeners, I suppose, who are moving cross border, there's the additional complexity of how does this marry up with the outcome I would have expected in my, my prior tax return. But yeah, look, it's great. And like you said, there are market, you're one of the specialists I would think of when it comes to EIS. It's a niche area, even within the tax market, isn't it?
Yeah, because of the risk involved, right? As a
Mm,
you're giving your clients, you're trying to give your clients, the company, comfort on a relief where the potential downside is very significant for them, right? And we can all read Irish tax law, the sensitivity with it. And I'm just going to go on a metaphorical high horse here, right?
yeah,
The
go
um
for it.
the sensitivity as a tax advisor is that it's state aid, right? This relief is state aid and it's governed by EU rules. And the EU rules are just not my view, right? And I can give my view because I'm my own practice, right? But my view is that the EU rules, right, they're not fit for startups, right? This particular EU regulation that we're working with and was not designed for high performing startups. And there is no regulation that has been designed for. And we're supposed to be trying to compete with the US as a hub for startups. And this regulation just doesn't work. It was amended a year or two ago for green activities, right? But no specific change for startups. So, for example, one of the conditions that we need to work through, and a really finicky condition, is that the balance sheet that you can't have a negative balance sheet, right? Now there are some outs, but generally that's the concept. And that doesn't work. So you can't have like lost more money that you've got in, right? Through your balance sheet. And most of these startups, they're spending money. That's the whole point of them.
That's why they need the cash.
Yeah, I know. So you're trying to and working with very frustrated founders who have VC and real investment coming in, people who have invested now, right? But they're seemingly failing this test. And the test is, and the background to the test is that we're not, the EU isn't supporting companies that aren't viable. That's the purpose of the test. And it just needs it needs more. I think the startup, there's so many, and as a founder, right, one of the first people I would go to is the startup hubs, right? And there's lots of alliances, but there probably needs to be a more concerted EU level of those hubs and government to try and get it more on the EU agenda. It's supposed to be on the EU agenda, but it's just not coming down. So yeah, so can I get off my high horse? Stay on
I
it for the rest
know.
of the conversation.
It's this is very interesting as well. And I think, for people who are coming to Ireland and learning about, one of the comments we often get is, wow, like investing in Ireland is just so different to the US or to the UK. In the UK, you've got ISAs, in the US, you've got an active market where you can kind of buy anything you like. For investors generally coming to Ireland with, cash, What are the things you say to them? I know you wrote a fantastic article for Chartered Accountant Ireland a few years ago, which is brilliant. It talks all about the kind of pitfalls. What are the takeaways you'd have if you're talking to investors generally to watch out for? Maybe if we focus on people investing through their own company, we'd spoken about share schemes was one that we were going to talk about as well, or for
Oh yes, so
employees.
sorry. We're just on investing through your own company, right? And just a pitfall of the 12.5%, and just to be, yeah, definitely to be wary of this point
Yeah.
for individuals coming to Ireland, right? And they hear the 12.5%, and think this is great. I have all of my consultancy money, all of this money in my company. I'm going to use this as an investment vehicle. Pay 12.5%, brilliant. Unfortunately, Irish law doesn't work like that. The tax rate in an Irish company at 12.5% only applies to trading activities. Everything else, the rate is 25%, or sometimes 33% if it's a capital investment, if you sold shares, we'll say. And also potentially where you leave that, there's anti-avoidance provisions where you leave the money roll up in a company longer term, then the effective rate goes up to around 40%. So as a rule of thumb, us tax advisors say to people, rental income, because Irish investors love property. The default rate in a company on that income is 40%, which is slightly better than in your own name at 55, but not much if you're thinking of potentially having this asset in your own name and the double charge to tax. So there's a whole host of things to kind of work through with a client as to whether investments should be made in the company, and also those investments may prejudice. I mentioned that retirement relief and those CGT reliefs. And those exemptions, and they mean your company, and all of those exemptions work really well, but are targeted at trading. The Irish tax regime is really targeted at trading entities, and where you contaminate or have bad assets, it can make it a bit of a nightmare going forward. So that's always one that's maybe I think certainly people coming to Ireland with that kind of profile, it's a new one for them.
And I know we get that a lot. I'd like to buy an investment property. Should I put it into a company? And my answer is a little bit like yours. It's generally that, well, no, like don't do anything here now until we kind of step it through that. I think that headline 12.5% rate can be a bit misleading for people because it's not really commonly understood that it is very much targeted at trading entities, and again, other conditions apply. So we have to think around the efficiency. We don't just focus on the actual rate that applies to the profit being generated on an ongoing basis. You've alluded there to, I suppose, things you'd love to see changing in tax law or policy. Is there anything else that you'd love to see changing in the Irish regime?
That was my sorry, yeah. That was when I was on my. That was the main. I wanted to get across. I wanted to give out about the EU regulation. For startups, right? For
Get back on your
startups,
horse.
yeah. For startups, I actually the reliefs that are there, right, are really good in theory. There's another one. I just want to just for founders, right, and share schemes, because that comes up a lot.
Yes, I'd like to touch on this as well. Yeah.
Yeah, so there's two. So, by far, commercially for a startup company, share options are ideal and they work lovely. There's really limited admin. So, from a commercial perspective, the employees only they have limited involvement in the company, but they have the economic value if the shares go up in value, and the employees are quids in. The sensitivity with share options is the tax rate on them is absolutely horrendous. The gain on a share option is like you've received salary and your default rate is 52%. Sorry, that when I talk about the 50%, I talk about the marginal rate, and that's the top rate you'll pay, which is quite a lot for employees. So generally your boilerplate is the share options, right? A few years ago, the government did try to introduce a regime for and it's still there. And it's called Keep, right? And where you qualify as a startup, then rather than the 52% for the employees on the exercise, then the rate is the capital gains tax rate at 33%, which is it's a grand answer, right? Compared to the 52%, it's lovely. Keep is also one of these ones that are subject to a lot of conditions and the EU regulation. But at the start, right, when you're setting it up, there's no reason why you wouldn't structure your ESOP so that it could qualify for Keep, right? The admin at the start is relatively light. So I always say where you are going for a basic share option scheme, and your lawyers have given, just to make sure that it would qualify for the Keep as well. There's not too many changes in the conditions to me. And sometimes the lawyers have that. It's they've already considered and they're satisfied, or they won't give you assurance that it's key, as in because it's, they're not tax advisors, but they try and ensure that it could be met. And then from your side, it should be just, if there's no one exercising the shares, then it's just annual compliance, which isn't the worst thing in the world. You can always worry more about it when they exercise. But at the start, I always say, let's try, if you are a share option, then let's try and target this.
It's a very good point, actually.
Yeah, no, I wanted to, because a lot of time, and lawyers just are afraid of it, but there's nothing to be lost from trying to get it. Commercially, share options from a company work better, right? But from a tax perspective, what works better is just having the employees as owners from the start. So, because if the employees get the shares when the company's worth nothing, then that's their tax point. They've got something, and the company's worth nothing. Therefore, their tax is nothing, and all of the uplift goes to them, their normal capital gains tax rate. If they have more than 5% of the company, then their tax rate is 10% on disposal. So that entrepreneur relief rate, which is limited at the 1 million, it's on the we're always as I'm part of some representative bodies, and we do lobby for the limits to be increased, but still the generally, and for those kind of employees, that 10% rate for those shares is very good, right? The sensitivity is there's a lot of people on the share register, and their share, you're giving up equity, and you can structure it so that they have limited rights and different classes of shares. Or you can also structure it where the company has value, and this is common also in the market, where the company has value, that there's something called a growth share, where the employees come in and the shares only come into value once certain thresholds are made.
Flower at a certain point.
Yeah, flower. And also you can restrict that the employees can't sell the shares for a number of years, and that reduces the taxable value. For all of those, after day one, for all of those, then in my view, right, you probably will have a small tax point, being there is some value that the employee will be receiving. But it works very well from a tax perspective. It is very complex on the it's complex on the legal side. It's not impossible, but just you're a startup and you've got a million things to do. There's a bit of work from a legal side and a commercial side, even determining exactly the terms of these shares and what you want and don't want, voting. All of that it's complex.
It's complex, and I suppose it's preempting value that may not yet have crystallized. So therefore, you're investing. I mean, it's a great point to kind of incentivize employees to come work for you. We generally find employees love these schemes because, it aligns, HR performance, they work very well from a commercial perspective. But of course, there has to be kind of quids in to kind of get it all up and running, stay compliant, and then hopefully cash out at the right point. And just to touch on that and kind of, I suppose, give an overview. So the parties who you would work with routinely on those would obviously be the accountant, yourself, and legal advice.
Yeah, mostly with the lawyers, right? The accountant,
Right.
those kind of companies, the accountant is relatively, it's mostly lawyers and myself. There is an accountant, they are an external accountant, but it's mostly getting the documentation and structuring right. So sometimes the accountant might refer me, or else might one of the invest. They realise there's an issue here, or a problem here. Or actually, a lot of those is the lawyers themselves who are, and they're specialist lawyers in this field, and that you wouldn't, not your kind of high street solicitor, and that there are ones who deal mostly with startups. And I would think that's why I would always suggest that there's a lot of hubs and startup, they will have the names of people who
That's it.
who are the right ones to go to. You don't want to reinvent the wheel.
No, just, tread the path that is well trodden, and don't make life any harder for yourself. Maura, we could talk all day about any of these topics, and even for me personally, I love hearing kind of your insights and experience. What's next for Gintax? What's your plan? Because you've obviously you've had a very successful few years. You've grown exponentially very quickly, and it's easy to see why, because you bring so much to the table for your clients. What's your plan?
To grow beyond me. No, in fairness, so I have two other advisors, right? And I see a real, more than your own firm, Stephanie, there's a real market for specialist niche tax advice, and there are less and less firms in the market, right? And a lot of consolidation, bigger brands, bigger firms. And I see a role for an independent firm who are solely tax advice and work alongside a lot of those firms who may be conflicted, or else someone wants a different view or a different opinion. So my main aim in the next, it's not clients, it's trying to get people and staff, and a couple of more hires and other advisors. I'd be agnostic on where they come, what level of experience they have, because I'm conscious most tax advisors in this market are in big practice and are mainly servicing big multinationals, so may not have what we're doing and what you're doing. I know Stephanie as well is relatively it's relatively small, or
small pool of talent, perhaps.
Yeah, exactly. So if I was to try and recruit from the people who are already experienced in that market, it's not going to work. I do think I like, it's not but I think if you've got a good brain for tax, if you're good at tax generally, right, it's the same it's the same law. We add on the Capital Acquisitions Tax Act, but broadly it's the same red book.
Exactly. It's the same red book. Yeah.
I do, as a tax advisor, it's my one luxury. I do buy the hard copy every year. It's my luxury. Desert Island item. Oh God, I'm such a loser. No, it wouldn't be. It wouldn't be.
If you were attracting people to work with you, one of the things that kind of comes through from what you've said is, the variety the role offers. I get the sense that, your clients are front and center of everything you do. It seems as well that you offer a role to anyone who's interested in working with you that kind of allows them to, I suppose, have their own personality and have work-life balance as well. Is that kind of what you feel you could offer?
Yeah, culture, right? So I don't view myself as, I'm not a natural entrepreneur, right? I prefer not to be trying to set up my own practice. But right, what I know there's a market for this tax advisory in this market, right, as a specialist firm. But I do think, but there's limited amount of firms that are doing it, and those firms, and I haven't but we can do it a bit differently, right? A lot of them are like mini big practices with the same policies, the same, exactly everything same, but just on a minute level, right? And they don't need to be. We can do it. I think you've got very similar similar thoughts here. We can do it differently, and we can question why we're doing it like this. Does this work? The world has moved on so much. And I certainly think we're both very much on the same page regarding people and flexibility and trying to build a firm around the people more so than the firm. Now, there is a balance. I do appreciate that, but
definitely. Yeah, I totally agree. And I think it's amazing how receptive really good candidates are to that type of an attitude. It's amazing because, I think the world that we live and work in now is very different to what it was even 5 years ago, pre-COVID. And, it really gives you an ability as, a founder of a practice to kind of position yourself slightly differently if you think a little bit differently.
Yeah, but it's not, and I'm surprised there's not many more people doing it. So for example, someone who wants to work, someone who wants to work 2 days a week, right? I'm fine with that. No issue at all. That's lovely. So being very flexible to their needs is, and, even even the hours or the core hours, 9 to 5:30, I don't care, right? As long as the work gets, just that.
As the works get done. And I think as well, the beauty as well of, even from people coming, we often hear, for clients coming from some of the bigger, like it's experience with maybe a larger service provider, they actually really enjoy the fact that they get to have like one person. They're not dealing with a team of people. They have one direct contact. They understand that person may not work 5 days a week. So it's easy to manage as well when you kind of everyone understands the expectation.
Because we're in that I generally find with tax advisors, and even in where we work, it's just people work really hard. You work really hard, and if you're into it, right? So it's not like if you're not there at 9 a.m. that you're not working, right? There's a lot of distrust.
It's we're a funny breed, aren't we?
We are, but if you're into it, then you're into it.
You're just, we shouldn't explain it. We just have to accept it. But But what do you do? And before we finish up, because I think it's nice for us to share as well. I do follow you on Strava, and I can definitely vouch for the fact that Maura is super fit. She's way faster than I am at running. But apart from running, what do you do? You are. I've seen your times. You're excellent. You're excellent.
I'm still faster. Geez, Stephanie, you need to up here.
What do you do outside of work? You obviously run. What do you enjoy aside from that?
I do. So I do feel passionate because when we were back in KP, in my younger days, right, I didn't have any hobbies really outside bar socializing and my profession, right? So I would feel passionate about having, and I've now I've completely changed, right? And I love the running, as you mentioned. I love hiking. Going like myself and my mates go on a big European hike every summer, and sometimes. Well, before I started my business, we used to go just to go further afield, but it's been Europe for the last few summers, and I love what else do I skiing. So one of the things that's with skiing, and I really enjoy, but it's a winter sport, right? And January is a quiet time of the year certainly for tax advisory structuring works. And I find it like I can go skiing now, right, twice or in that period, and it's not a big deal for my business, right? But if I was like stuck with 25 days holidays, it would be eating into most of my annual holidays for, that would be way too much. So I just love that flexibility now in my life that I can do this. Equally, I know I don't have kids, but I know people with kids love the summer months you're a proponent of this.
We're going to Thailand again. So
but we only have so many summers in our lives, and I do find to try and step back a little bit at summertime and just to enjoy your friends, and it'll very quickly ramp up again in September, October. But you get so much out of those hobbies and having a lot of interests that you can actually bring to your work, like the running, just as in you're pushing yourself, with competitive running, and even getting out the door and trying to do a session and knowing, I've done that, and you can bring that.
I'd actually kind of go further as well and say, when this probably sounds silly, but when your advisor actually is not just necessarily working and doing nothing else, they're in a better position to advise you about maintaining perspective when you are going through these big commercial deals. Like, in other words, exactly back to your point earlier on, why are you doing this? What do you want to achieve? Don't just solve, I don't like paying tax. Work out, why are you paying tax to begin with? It's because you work. Is that what you want to do? I mean, I'm not to say we're life coaches or, financial therapists.
Where it comes up a lot is the moving abroad.
Totally. Comes up all the time. I'd like to leave my family and live in Dubai for 3 years. And I'm like, really? For tax reason only? Let's step this through. It's complex. I actually thought, you said something here in your notes. I love tax, so it's very difficult, and need to want to engage with it and with clients. We need the two. And I think you're right. It's about enjoying the technical aspect of it, but also it's a very people orientated.
Oh, yeah. That was my promo to try and get staff, try and get more advisors working with me.
Contact Maura. Actually, Maura, for reference, anybody who would like to send their CV to you, anybody who has questions about incorporating an Irish service-based business or other insert trading company here, anyone who is a founder of what might be a unicorn in future, or who has questions about things we've spoken about today, how should they contact you? And what should they put in the subject line to catch your attention?
Unicorn. No, everyone wants to found one.
Unicorn.
You just email me at maura@gintax.ie.
Fantastic.
I get that.
Fantastic. Yeah. I so enjoyed talking to you. We could talk all day. And you know what? Being able to just kind of cut through the complexity of what is, that red book we spoke about is a beast. And you've really succinctly and nicely explained it for people who either know a little bit, want to know more, or need to know more. There'll be people in each of those categories. Thank you so much for joining us.
My Garmin. Can I say my Garmin as well as the TCA on the desert island?
Sorry, no, you said the red book now. That's it. There's no Garmin.
Such a loser. Okay, thanks a million, Stephanie.
Thanks, Maura.
Bye-bye.
Thanks for listening to Tax Bites for Expats. Please do leave a rating or review wherever you listen to your podcast. And as always, remember to take professional tax advice specific to your personal circumstances before acting or refraining from action in connection with the matters dealt with in this series. The material in this podcast is intended to give general guidance only.